Hi everyone, welcome back. What we're going to do in this session is go through the practice midterm for chapter 11 together. So what I'll be doing week to week is, as I've mentioned a number of times, is put up the practice midterm, and then during that week record a lecture where you can see how I help you work the problems. I've given you the answers, but I think it's helpful if I go ahead and walk you through and show you how I'm going to be testing you on this material and give you some tips as to how to answer the questions, etc. So that's what we're going to do for this practice midterm for chapter 11. I'll be putting one up for chapter 10 here pretty quickly as well, and that's what we'll do week to week. Again, there'll be slides, there'll be a lecture, which you've probably seen by now, where I will walk you through the slides, give you examples, talk about how to approach some of those things. And then there's some homework questions that are in Wiley Plus that, you just need to spend some time with those. I'm not being very critical in the grading of the homework. As long as you try it, I'll give you and it's not an overwhelming amount of points, but the 1 point per chapter. And then you should start looking at the practice midterm. And the practice midterm, like this one that we're about to go through for chapter 11, is really the best indication as to how I'm going to test you on this material. Now when you look, there'll be all multiple choice questions in this file. As we move a little closer to the exam, I'll get to your actual midterm. I will give you some examples of how I would test you in a full-blown problem format type of thing. Remember, we'll have one question like that will constitute 20 points, and multiple choice questions, like we see in this practice midterm, will be worth 4 points each. There'll be 20 of those. Okay, good. So I want to go ahead then with that, and let's start to take a look at our practice midterm. See if I can do this without messing everything up. Take a look at our practice midterm here for chapter 11. Okay, and I just want to double check there and make sure that didn't turn itself off. Okay, good. So let's take a look at chapter 11, practice midterm. You have this file on e-learning. Maybe you've worked with it a little bit already. If not, this would be a good time to take it out and go ahead and work along with me on this. Okay, good. So we've got this example. This Slokin Products purchased a machine for $65,000 on July 1st, 2020. The company intends to depreciate over 8 years using, and in this class for practice, for the most part, I'll use double declining balance. Remember, it does not have to be double declining balance. It could be triple declining, could be 150% declining, but it's going to be a multiple of the straight line. And in this question, they try to mess me up a little bit by giving me the salvage value. Now remember, we talked in the lecture where we said, hey, we won't depreciate below the salvage value, but salvage value is not used in the calculations. So since they're asking me the depreciation for the first year, I'm obviously not going to, depreciate below the salvage value in the first year. And I don't use the salvage value in the calculation for my accumulated depreciation. So I really need to know to ignore that. The other important aspect of this problem is you've got to be aware that we've got this July 1st start date. So that means that since we purchased the equipment on July 1st, we're not going to take a full amount of depreciation for that full first year. Okay, so we start to go ahead and we notice some of those things right off the bat, and then we say, well, what is my double declining balance rate? Okay, so since it is an 8-year life on this, if we were using straight line, we would take 1 divided by 8. That's 0.125. Okay, guys, I've said it a couple of times. When you're taking an exam, when you're doing questions in the accounting world, you do not do anything without a calculator. I don't care if you look at 1 divided by 8 and say, well, John, I know in my head that's 0.125. pull out a calculator. Make sure. It is so easy to make a mistake when you have a lot of moving parts in a question. And when the examiner, when the textbook puts together these questions from the test bank, they know the common mistakes that are made by folks, and so they set up choices that are in line with common mistakes. So you're flying through the exam thinking you're doing great. Meanwhile, you're falling into all the pitfalls because you're not being vigilant about using the calculator and whatnot. You have 3 hours for this 20 multiple choice questions and this one full-blown question is the way I'm going to set up the exams. In e-learning, plenty of time. There is no reason for you to be rushing through the questions when you're going through and doing this. Okay, you're going to practice with these practice midterms. You're going to be very fine-tuned as to how to work these questions. So be careful. Use your calculator. I'm not using my calculator right now because I already used my calculator to figure some of these things out. Okay, so we have what? We have 0.125, but because it's double declining balance, 0.125 times double times 2 gives me 0.25. So the depreciation rate per year, every year on this thing will be 0.25. Now, since I'm not using the salvage value to do my calculations here under double declining balance, I'm going to take that 65,000, I'm going to multiply it by that 0.25, okay? And when I do that, I get 16,250. Now that would be the depreciation for year 1 if I had purchased the equipment on July 1st. But since I didn't purchase that equipment until July 1st, July 1st is going to be what? That means that we would have had all of May, all of June, let's start, John, with January. All of January, February, March, April, May, June, 6 months. That's the other thing I like to do on these questions. I count on my fingers because if you look at July and you think in your head, you might say, well, July is the 7th month, so that's 7 months. But we didn't depreciate for any of July, so we're going to depreciate it from July forward. So the other way to do it is July, August, September, October, November, December for 6 months, okay? So 16,250 times the 6/12 gives us this 8,125, which is choice B, okay? All right, good. We're off to a good start here, okay? All right, let's look at this next one, and we have this Sulkin purchased machine for $65,000, July 1st, 2020. Okay, same fact pattern so far as the first question. The company intends to depreciate it over 8 years using double declining balance method. Salvage value is $5,000, but now they're asking me for depreciation for what? For that next year. And so under double declining balance, we do what? We take the new book value at the start of the second year, which is $65,000, minus the depreciation that we took from the year 18125, right? That gives us at the start of the new year, that gives me a depreciable base. And I thought I wrote that down, but I didn't. I always use the calculator. I don't do anything in my head. 65,000 minus what? The 8125. That 8125 now gives me 56,875, okay, as my declining balance to start year 2. So then I take that 56,875. I don't have to recalculate 0.25 because it was the same fact pattern. Okay, they were just asking me for the next year now. Times 0.25 gives me $14,218.75. And they asked to the nearest dollar. I'm never going to give you a question that tests or pushes your rounding ability, okay? So that's the obvious correct answer there, okay? I'm not going to get into, hey, you got it 2 cents off, There'll be, 4 choices like this in which there's obviously wrong ones. There's clearly a correct one, okay? All right, good. Okay, so that's the key takeaway there. Oh, I know what I wanted to say. And I may give you questions that leverage off the same fact pattern. In some ways, I'm using a situation like that to sort of test your ability in a manner that I might use to test you in a full format where you have to get the first one right to get the second one right. Okay, so I may do some of that as well on your exam. Okay, good. Let's look at this next one. Okay, Grover Corporation purchased a truck at the beginning of 2020 for $109,200. The truck is estimated to have a salvage value of $1,400 and a useful life of 120,000 miles. It was driven 21,000 miles in 2020 and 29,000 miles in 2021. Okay, what is depreciation expense for 2020? Now, when you look at this, they don't give us the useful life in years. They only give me the useful life in miles. So that is an indication then that I must use the units of activity method, right? So I'm not going to be able to use, or it didn't call out the method I have to use because it didn't tell me the years. So I can't use straight line and I can't use declining balance, so that I can't use sum of years digits. So I'm only left with units of activity because they only gave me the miles. Okay, so I use this 109,200. That's the cost. I subtract 4,200. And guys, be careful with that. It is an easy mistake to make. When I was practicing with some of these questions, I did it a couple times. I had to yell at myself, right? What happens? It is an easy mistake to make to forget to subtract the salvage value and calculate your depreciation per year, per unit, whatever, without the salvage value. And there will be a choice in here that will probably comport with the mistake of not subtracting the salvage value. So be careful, okay? So I have this 109,000 and I subtract the 4,200, and that gives me, and again, I wrote this down, but now I can't read my own writing. Surprise, right? Gee, how could a guy who has neat writing like you not be able to read your own writing? 109,200 minus what? Minus the 4,200 gives me 105,000. And of course, I'm kidding about the neat writing. When I took one of my first accounting exams, I got 100% on the exam. That wasn't my first exam. It took me a while to warm up to accounting. But once I started to get it, I got 100% on the exam, and the teacher wrote an F on the paper. And I went up and I said, "But I got 100%. Well, what are you doing here?" And he says, "Oh, I'm sorry. I don't write real clearly. I'm not a real clear writer. I meant to put an A on there." Okay, so he was telling me, "Hey, I saw what you did, dude, but man, you made me go through all kinds of hell to read your writing." And so I've always had poor penmanship. When I was a kid, the teacher used to, send notes home with me. John can't stay inside the lines. Okay, so I've always had that problem. Please forgive me. I'll try to write as clearly as possible. It is important to listen to the words that I'm saying to best understand what I'm trying to write down as clearly as possible. Okay, but it's not very clear. I understand that. Okay, so then I go ahead and I divide that by the 121,000 miles. Okay, and that gives me, and I'm going to go ahead and just put it in my calculator anyway. Okay, good to verify your calculations. Even if you make the calculation the first time, go back and recalculate, verify that. Okay, and so I get my 0.875. Okay, and they're asking me for what? 2020. I drove this equipment, this truck, whatever. In 2020, I drove it 21,000 miles. So I go ahead, I multiply that times 21,000. That should give me the correct answer here, 18,375. Guys, I'm not going to check that calculation in my calculator because I did it earlier. I wrote it down, and it comports to answer B. Okay? Okay, good. Let's take a look at this next one now. And we got Grover Corporation Same fact pattern. Now they're simply asking for 2021. So they tell me that in 2021, they drove the truck 29,000 miles, 29,000, right? Okay. And you may look at this and you may say, oh boy, John, test us like that, because then I can use the information from the previous problem to answer the second problem. That's a time saver, but it's also be careful what you wish for, because now you had to get question 3 correct to get question 4 correct here. Okay, so that's 23,375. Okay. All right, good. Good. If I'm taking this exam, I'm feeling pretty good about myself right now. Okay. All right, good. Carson Company. Let's look at number 5. Purchased a depreciable asset for $560,000. The estimated salvage value is $28,000. Estimated useful life is 10,000 hours. Carson used the asset for 1,500 hours. In the current year, the activity method will be used. This one came right out and told me activity method, okay, even though it didn't give me years anyway, but this one was a little more specific that they wanted me to use activity method. I don't know that I could answer this question any other way. What is the depreciation expense on the asset for the current year? Okay, so this is getting a little redundant now, but we practiced with this stuff already, so this one by now is pretty easy for us. 560,000 minus the salvage value. Guys, don't forget to take the salvage value. It's an easy mistake to make. I hate to say it, I've been looking at accounting for like 35 years now. Oh my God. And what happens, I still make the same mistake. I forget to subtract the salvage value. Easy mistake to make. And I don't want to see you lose points on your exam. Because of something silly like that, okay, or easy mistake to make like that. 532,000 divided by what? Divided by 10,000 hours means that the depreciation rate per hour for this one is $53.20 per hour, okay, and they tell us here $53.20. Right, that they drove the thing in the current year that they're asking us for, 1,500. Make sure you pick up the right number of hours in the question, because sometimes you saw for the previous, they might give you a couple of different years, hours used, whatever. And so the answer here, when I do the calculation, is 79,800. Okay. All right, good. And so that's choice B. Okay, so not too bad. Okay, we're doing pretty good with this exam. Testing our understanding of a couple depreciation methods here. We've used units of activity. We used declining balance. We're going to take a look at some of year's digits and composite depreciation here in a couple minutes, okay, in a little while. But let's go ahead and let's look at this one. Jasmine Company purchased a depreciable asset for $375,000. The estimated salvage value is $25,000, and the estimated useful life is 8 years. We're going to use double declining balance method will be used for depreciation. What is the depreciation expense for the second year of this asset? Now, before we go any further, I want to just lay out a cautionary tale here. I was giving practice exams in a class, and in that particular class, the double declining rate kept coming out to 0.4, and I had a TA that was helping me at one of the big universities where I was teaching. They give you a TA to help you with the class, and the TA told the student that, the depreciation double declining rate is always 0.4. I don't know how the person possibly thought that. It depends on the years. So I'm pointing that out because we've had 2 in a row where it's 8 years. It depends on the number of years in calculating that rate, right? Okay, but this one is 8 years again, like the previous one we had. So we know that 1 divided by 8 equals 0.125. And when we double that, we get what? 0.25 as our depreciation rate. Now they tell us that the machine's cost was $375,000. They give me that salvage value, but I don't use it in the calculations, and they're asking me the depreciation for the second year. Again, we're not going to be depreciating below salvage value in the first couple of years using double declining balance, so I know that I can ignore that 25,000 of salvage value there, right? Okay, so I take that 375,000 times 0.25. That gives me what? That gives me, where did I write that down? I'm not going to use my calculator because I already ran it through the calculator and got the answer 93,750. That's for the first year. Then I'm going to take that 93,750, right? I'm going to subtract it off of the balance from the beginning of year one, okay? By the way, this question has a flaw in it. They really should have told me when they purchased it. They make me assume here that they purchased this at the beginning of the first year. They don't tell me, and so they kind of have me wondering that, and I don't like questions that sort of make you feel around in the dark. I mean, if I was a company, I would know when I purchased this darn thing, and I would have that information as I'm calculating depreciation. So why are they hiding that from me? So I will avoid questions that have an ambiguity in it like this one does. I can tell you that to get this right, you had to assume that they had purchased it at the beginning of year one. So I end up here with this 281,250. Okay, and I just feel I want to verify that calculation for some reason. The auditor, the accountant side of me is saying verify that. 375,000 minus, right? And you can do this along with me, right? 93,750 gives me 281,250. Good. And then I go ahead and I multiply that times 0.25. And when I multiply that times 0.25, I get $76,312.50. Please, God, let that be one of the choices. And it is not, because I can't read my own writing. It's not 76, John. It is what? 70,312. My sixes sometimes look like zeros. Or my zeros look like sixes sometimes. Okay. Okay, good. So we're good there. All right, so I think you're getting this sense as to how these depreciation type questions will go. Now this next one is going to be sum of years digits. Okay, I'm just going to tell you that right off the top. And the life here is 9 years, okay? I'm going to stay away from long lives like this on your exam. I will not have lives in excess of 5 years because I don't really care for testing you to say 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 equals, and you end up seeing that equals 72. Okay. Now I'm just going to remind you, remember the exams are going to be open book, so you could have done that too, that you could use the formula of n. Okay, if you get a really long life, I mean, if it's a shorter life, it's just easy enough. 1 plus 2 plus 3 on the calculator, right? But if you get a longer life, I don't know, maybe you're taking a class from somebody else and they give you a long life, or maybe you're taking a CPA exam, although they tend to leave it, the exam, not more than 5 years as well. But if you need to, you could look up this formula, because I'm giving you an open book exam. If you felt the life was too long, or you wanted to verify your 1 plus 2 plus 3, then you could do that too. Okay, so what happens now, since they're telling me that this what is it, a truck or some machine has a 9-year life, now I can go ahead and plug in the numbers, right? So it's going to be 9 is the n, 9 plus 1, okay, divided by 2. And when I use that, yeah, that gives me 72, okay? So I go ahead and that gives me 72 for the, this gives me 72 for the the numerator, and then the denominator, of course, using the formula is 2. So that means that my sum of years digits is not, I think I said 72, it's 36. 1 plus 2 plus 3, so on, would give you this 30. Sorry, guys. I'm doing this. I'm looking at the wrong notes, so sorry to confuse you. Okay, 9 times 10, John, is 90. Okay, 90. Okay, divided by 2 gives me what? Gives me 45. That's my sum of years digits. If I did 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9, I would get 45 as well. So you could use that to verify your calculations. Okay, all right, so I've got the sum of the years digits here. Okay, now the salvage value was estimated to be 150,000. Depreciation was computed using sum of year digits method, and what amount should be shown on Garden's balance sheet as the net accumulated depreciation for this machine at December 31st, 2021. So that means that I would have, since I bought the equipment on January 1st, 2020, the accumulated depreciation should reflect the depreciation from 2020 and the depreciation from 2021. Now again, for sum of years digits, the only time you don't use the salvage value is in double declining balance. For sum of years digits, straight line, I have to use the depreciable base. So I take this 4,200,000. I subtract the salvage value, which is 150. And when I do, I get what? I get 4050000. Okay, that's my depreciable base right there. So now I go ahead and I start to do my calculations. Okay, so what's going to happen in the first year? Where do I want to write this? I'm going to write it up here, guys. Okay, for my first year, for 2020, now I'm going to take 4,050. I'm going to multiply it, and for the first year I multiply it by 9/45. And when I multiply that by 9/45, okay, my notes are horrible, so I'm just going to do it like this. Where am I? 4,050,000 times 9 divided by 45 gives me 810,000. Yeah, 810,000 for that first year. Okay, so I go ahead and I have my accumulated depreciation T account over here. So for the first year, it's 810,000. Okay, then for 2021, because remember they want the accumulated depreciation after the end of the second year. Now I multiply that by what? By 8/45. Okay, and again, I'm going to verify my calculation. 4,050, you could do it as along with me here, times what? Times 8 divided by 45 equals 720,000 for year 2. Okay, so I go ahead and I subtract or I credit my accumulated depreciation for the 720,000, and when I add that up, that gives me a total of a total of 810,000 plus 720,000 means that there's 1,530,000 sitting in my accumulated depreciation. Okay, now they're asking me what should be shown on the balance sheet for the equipment net of the accumulated depreciation. Now, easy mistake to make would be to say, well, go to 4050 and subtract off that. Easy mistake to make. No, when I present it on the balance sheet, I'm going to show the equipment. Equipment will be $4,200,000. And then I would subtract the accumulated depreciation of $1,530,000. Sorry, guys, I know that's hard to read. That's $1,530,000, giving me what? The net book value of this thing. And again, I'm going to verify my calculation here. $4,200,000 minus $1,530,000, going to give me $2,670,000 that's showing up as the net book value, answer B. Okay, the answer is kind of buried in the middle of my calculation there. Okay, all right, so a couple takeaways from this question. One, I'm not going to make you go through 9 years. It'll probably be 5 years, etc. And then the other major takeaway or major stumbling point, when you're done working a question like this, make sure you know what they asked you for. Verify. Go back. What did the question ask me for? Okay, it asked me for the net book value. Net book value in the balance sheet is the original cost of the equipment minus the accumulated depreciation over 1 year, 2 years, however many years you would have had to have done there. Okay? Okay, good. A little bit tougher question. I don't know. I'm not going to get all hopped up on some of your digits. I might give you one question. Some of your digits a little old hat. It's still asked on things like the CPA exam, so we feel inclined to cover it a little bit. But some of your digits are not used that much. And again, if I was going to use it, I'd have a much shorter year time frame to make it a little, make it not as cumbersome as that. Say these couple ones that we're looking at. Okay. Okay, good. So here we go again. Some of your digits, right? Fairly long life on this equipment. It's 8 years. Okay, so let's just go ahead and get that little tedious piece of business out of the way first. N is 8. N plus 1 is 8 plus 1. And we divide that by 2. And when you do the numbers on that, that's going to give me the 36. Okay? Okay, good. So when I look at this question now, they're asking me what would be the charge for depreciation for the year ended December 31st, 2021. Again, I regret having given you questions like this as part of your practice midterm, because I'm not going to give you anything that has you doing something like we were about to have to do, which is count off a bunch of years here. Okay, so my time frame would be much shorter when I ask you this. So what happens? They purchased the equipment in January 2014, so they would have taken depreciation for what? For 2014, 2015, 2016, 2017, 2018, 2019, 2020. So of the 8 years, they would have done what? They would have done 8 30-seconds in the first year, 7 30-seconds, and so on. And they're down now to what? To the last year. The 8th year is 2021. And in that last year, I only take what? 1 36th or 36th in this example. So I go ahead then and I take this 390,000. I subtract the salvage value. Easy mistake to make, guys, is to forget to subtract the salvage value. That gives me 378,000. And since I'm in the last year of the life of this, in the last year you take just one of whatever the denominator is. In this case, it's 36. The sum of the year's digits, 378,000 times 1/36 equals 10,500. Okay? All right, good. Okay, are we done with these sum of year's digits? I hope. Okay, all right. I don't care for those that much, but I just wanted you to have some exposure to it. And again, if I ask you questions on this, it's going to be a much shorter life that we're talking about for that particular item. Okay, let's take a look here, and they want us to, Orton Corporation, which has a calendar year, purchased a new machine for $80,000 on January 1st, 2016. At the time, Orton expected to use the machine for 9 years and sell it for $8,000. The machine sold for $44,000 on September 30th, 2021, assuming straight line depreciation, no depreciation in the year of acquisition, and full year of depreciation in year of retirement. Now, sometimes students will look at that and say, well, you know, where did we practice that? I don't know that we practiced that in any of the lecture, but companies' depreciation policy, remember, has to be what? Has to be rational, systematic, and doing something like this would not make a material difference in what you're calculating for depreciation each year. It would be fine to take this approach. And so they're helping me out a little bit here. They're telling me it's a gain when they actually sell the property for this $44,000. So let's see if we can figure out what that gain should be. So what happens? Well, we know that for straight line, we have to take 80,000. Okay, we're using straight line, just double checking there. Okay, for straight line, we have to use 80,000 minus the, don't forget that salvage value, guys, okay, 72,000. It had a, where's my 9-year life? It's a little annoying because you have to search through the words there to find the 9-year life. Okay, so it's 9 years, so I'm going to divide that by 9. That gives me 8,000 per year. Again, check numbers in your calculator, but I had done this earlier through my calculator, so I'm good. Okay, now it's 8,000 per year, and let's count the years. Well, they're not going to depreciate it in 2016 because that was the year of purchase, and they don't depreciate it. But they will what? Take a full year depreciation, even though they don't sell it until they don't sell at the end of the year. They sell in September. They'll take a full year depreciation in the year of sale. So if that's the case, 2017, they'll take 2018, 2019, right? 2020, 2021, because they're going to take a full year depreciation, none in the first year, full in the last year. That's 8,000 times what? Count on your fingers, guys. 5 years. That gives me 40,000 of depreciation that would have been in the accumulated depreciation account at the time that they sell this asset, or by the end of the year, once they catch up to depreciation, there would have been a accumulated depreciation of 40,000. Okay, so what do? I take the 80,000 minus what? Minus 40,000. Again, I take a full year depreciation in the year I dispose of that asset. That gives me a net book value, right? BV is book value of 40,000. I sold the thing we've already looked at for what? For 44,000. That being the case, if I sell something with a book value for 44,000, something with a book value of 40,000 for 44,000, that constitutes a $4,000 gain. Okay. All right, good. And I could very well give you a question like that. That looks like a nice example. I don't know that I'd get all off into this, you know, oh, well, it's, now I lost my pens. Wonderful. Okay, I think I have to click on draw here. That gives me, I don't know that I'd get all off into this situation, you know, full year depreciation in the year and nothing in the beginning, but I definitely would probably make you depreciate an asset, figure out the accumulated depreciation, and then you sell that asset and see what the gain or loss is on that. And it doesn't have to be a gain, it could be a loss. Okay. Okay, now let's look at this question 10. Now question 10 is a little bit of a hard question, and I may very well give you a question like this because this is a classic type of question that you would see on the CPA exam. Okay, so I think it's worth it to expose you to some of the things that you might see on the CPA exam, and that's exactly what this question is all about. So let's read through it. Let's kind of think about what we're going to do here, and the part that makes this CPA exam worthy is you have to figure out a strategy for how to get to the question, and I'm going to show you a common strategy that I like to show folks when we're teaching the CPA applied classes and whatnot to help you to understand this material, okay? How you help you understand how to answer a question like this. So during 2020, no company sold equipment that had a cost of $392,000 for $235,000, okay? This resulted in a gain of $17,200. So they sold the equipment, they got a gain out of it. The balance in the accumulated depreciation account was $1,300,000 at January 1st, 2020, and $1,240,000 at December 31st. So they give me the beginning balance for 2020, they give me the ending balance for 2020. No other equipment was disposed of during 2020. Depreciation expense for 2020 was, and you're like, how the heck am I going to get the depreciation expense here? They didn't give me the years that this asset's in use. How am I supposed to do this, right? Okay. Well, basically, they've given you the information so that you can calculate the depreciation expense. So what happens? When you have the beginning balance, okay, and the account we're going to analyze here, I'm just going to write up at the top here, accumulated depreciation is the account we're going to balance, we're going to work with here. And we have what? We have the beginning balance, and the problem told me that the beginning balance was what? $1,300,000. All right. Then we're going to have an add to my accumulated depreciation, and the add to accumulated depreciation is what? Depreciation expense. Right? You credit the accumulated depreciation, you debit the depreciation expense. So my add to my depreciation is depreciation expense. I'm going to move this over a little bit, take advantage of a little more room I have over here. $1,300,000. Now, I don't know that number. The correct number that's going to be here is going to be one of these over here. But I don't know what that number is. That's what my job is to figure that out. Now, every account in the world has what? Has a beginning balance, have some amounts that get added, have some amounts that get subtracted, right? So I'm going to subtract what? I'm going to subtract whatever the accumulated depreciation was for the asset that got sold. When I sell an asset, I credit the asset account, I debit the accumulated depreciation. If there's any cash involved, if I'm selling it for cash, I probably will. There's a debit to cash, and then the corresponding debit or credit for the gain or loss will, in this case, I guess they sold the equipment for, I guess they tell me a gain. So in this example, the corresponding credit would have been to gain. Okay, so I know I'm going to have to debit accumulated depreciation here, subtract. Okay, and then I will end up with an ending balance. Okay, and that ending balance, thank you, they gave me is what? $1,240,000. Okay, so when you see a question like that where they're asking depreciation expense, but they're not giving you the tools to calculate the depreciation expense, which would be the cost of the equipment, the salvage value, the years when they place that in operation, I don't know, how else would I answer it? You're going to have to squeeze to try to find the answer. And so what you do when you get a question like that is you just remember BASE, B-A-S-E, beginning balance. There'll be an add to that account. There'll be a subtract from that account. There'll be a resulting ending balance. Sometimes in questions like the CPA exam, hey, they'll give you the ending balance. Ending balance is a piece of cake for us accountants. It's a little harder when you have to move your way up the scale there to try to find out what the adds or subtracts were. Okay, so we know when we look at this, since we know they're asking us for the add, we have to then figure out the subtract. Well, what was the accumulated depreciation when they sold this asset that was subtracted from the accumulated depreciation account when they sold it, right? So they tell me that the thing had a cost of $392,000. They tell me that they sold it for what? $235,000, which was a gain of what? $17,200. Well, if that's the case, if that's a gain of $17,200, then I'm going to go ahead and take that $235,200. Okay, that's what we sold it for. That's the cash. And since there was a gain on that, right, that means that I can take that gain, I can subtract it off of the 17.2. Okay, subtract that off of the 17.2, and that means that equipment must have had a book value of $218,000 at the time that I disposed of that property. Again, just to make sure we're happy with that, we have what? We have the cash was $235,000. That's the cash. I'll write it underneath. I don't want to write it underneath. I want to write it next to it because I want this space underneath. Cash was $235,000 minus the book value. Book value was what? We just calculated the book value of the book value of the accumulated depreciation. The book value for this was the amount in the accumulated depreciation was the book value of the asset, not the accumulated depreciation, but the book value of this asset must have been what? Must have been $218,000 to yield a gain of what? Of $17,200. Okay, so now you look at that and you say, okay, good. So the book value of the machine was $218,000. How do I calculate now the accumulated depreciation? Okay, and I apologize. I think I said this was accumulated depreciation. This is the book value of the asset. If they purchased the asset for what? For, just coming back up, $392,000. Okay, and they tell me here that I calculated, they didn't tell me, I calculated the book value of that equipment was what? Was $218,000. That means that that equipment must have, the accumulated depreciation for that equipment must have been $174,000. Okay, so let me go back over that. Cash $235,000, gain was $17,200. That means that the book value must have been what? Must have been $218,000. They told me the cost. I subtract the book value from the cost, right? That gives me what must have been in the. I subtract the book value from the cost. That means the accumulated depreciation would have been $174,000. Okay, so now I know, I'm just going to move this down a little bit. So now I know my S and base that I subtracted. Okay, I subtracted $174,000 to get to $1,240,000. Okay, so what I like to do is I like to give myself, in a question like this, a little subtotal. Okay, so what I do is I do a little side calculation then. I take that $1,240,000. Okay, that's the ending balance. The problem gave me that. I calculated what was the accumulated depreciation on the property that was sold. I add that to the $174,000. That means that there was $1,414,000 in my accumulated depreciation account before I removed the accumulated depreciation of the asset that was sold. So if I had $1,414,000 subtract $174,000, I end up with $1,240,000. So then the question becomes, well, how do you go from a beginning balance of 1,300,000 to this subtotal of 414? So then you could just subtract 174,000 to get to the 1240. Well, I had to add some amount, and the amount that I had to add, and again, I do another little side calculation. I take 1,414,000. I subtract what? 1,300,000. That gives me a difference of 1,440 minus the 1,300,000. Okay. So let's look at that. Did I do that right? 1,414,000, right? And I subtract 1,300,000. That gives me 114,000, which I'm saying must have been the depreciation expense, because depreciation expense adds to my accumulated depreciation. Not 1,414, but come on, John, 114,000. Right? That's a 114,000. Now it looks like a 0. 114,000. Okay. Okay, good. And that's choice C. Okay. So that's kind of a hard question, right? I mean, you had to go through several layers there to get to that. I mean, the key thing here is to figure out what account you're going to have to analyze, right? And it's a little bit hard to see that off the top because they're asking you about depreciation expense. But if you look and they don't give you the elements to be able to answer depreciation expense, then you're going to have to start to look at a related account. And the only related account that I can think of the depreciation expense has is accumulated depreciation. And then you start looking and you say, well, they've given me the tools to be able to figure out what the add was to accumulated depreciation, and you go from there. Okay, that's kind of a hard problem. I'm not going to fill your exam with things like that because I think that that's probably maybe the next step for you as you start to get into professional exams and whatnot. But I think it's okay for us to kind of start to help you build up some of that muscle tissue. Okay, good. Let's go ahead and let's take a look at number 11 here. Okay, and again, I might give you 1-2 questions, not even, maybe one question about composite or group depreciation. The only difference between composite and group is group are similar assets, composite are dissimilar assets. Okay, and so we start to take a look here, and you can see that they give us some information, and then they want to know what the composite life is. Okay. And the composite life is going to basically be whatever you calculate as the depreciation per year, and you're going to divide that into the book value of these assets, and that's going to give you then the number of years. Okay, so first off, in this question, okay, and they set it up here pretty nicely to allow us to sit here and calculate the book value. Or depreciable base, not the book value, but depreciable base of each one of these. So 600,000 minus 40,000 is what? 560,000. Okay, and then I do the next one. 800 minus 80 is going to give me 720,000. Okay, try to squeeze that in. And then 300,000 minus 60,000 is going to give me 240. Okay, then I'm going to go ahead and divide that by the respective lives, and that's going to give me what? 40,000 per year for machine X. That's per year. Okay. YR, John, is going to give me year. Okay, and then 720,000 divided by 10 is going to give me 72,000 per year. Okay, and then I'm going to take this 240,000 divided by 6, and that's going to give me 40,000 per year. Okay, so I go ahead, and that means for this composite group, I'm going to take depreciation expense of 152,000 a year on a book value, right? Because I calculate my depreciation on book value, depreciable base, which is the cost minus the estimated salvage value here of 1,520,000. So you take that 1,520,000, right? You divide that by the depreciation expense per year, right? That means that I'm depreciating that asset over 10 years is the composite life of that, right? Because I would have taken 1,520,000 divided by 10 would have given me the 152,000 per year that I had calculated up here. All right? Okay. I don't know that I'd give you something like that. I don't think I'd give you something that complicated, but it doesn't hurt you to practice with that. Okay. The nature of the type of question I'm going to ask you with composite is probably more, I'm not going to go through this question 13. This is another sum of your digits question. Don't worry about that, okay? This is some of your digits driving me nuts now. Okay, don't worry about that question. I'm not going to ask you anything like that, some of your digits, all right? Because what I want to do is I want to jump to 14, because more likely what I'm going to ask you, and guys, I give you these practice exam questions, and when I'm sitting here hopping myself up on coffee, every question looks like, oh, I'm going to put this question in there, and then by the time I get down to looking at some of these in more detail, I'm like, I'm not going to ask you guys this, so don't worry about that 13, okay? But let's look at 14, because this is, to me, the major, and we said in the lecture, the major takeaway about composite/group depreciation is when you sell the asset, no gain or loss. You do not calculate a gain or loss on the time when you sell a piece of equipment that comes from that group, group of assets, okay? When you sell it, you will simply debit the accumulated depreciation for the difference between the cash and the original cost of that asset, okay? Now, when you look at these choices here, okay, and let's see if I can get the full choice at D here, okay? And now you've seen the answer, and by the way, when you work these questions, cover the answer. I don't know about you, and unfortunately, Wiley does not show you the calculations, so I'm going to go through, and that's what we're doing now. In fact, note to self, I'm going to try to remember to save this file so I can post up what I call the marked up version of this, so you can see what we did here. What was my point here? Try to cover up the answer. I don't know about you, but if there's an answer in a practice exam or something, I can't help but look at the answer. I can't stop myself. I don't know what it is. I lack the DNA code that allows me to ignore an answer that's sitting right there in front of me. So put another piece of paper over that answer or something, okay? So we know the answer is A here. But look, when you look at this, we know there's no gain or loss, okay? That's the major rule associated with the group composite depreciation approach. And so when you look at this, what? B is wrong. Okay, give me my pens back. Okay, so I know that what? I know that B is wrong. I know that C is wrong. There's no gain or loss. And I know that I'm going to debit the accumulated depreciation for the difference between the cash and the original cost of that equipment. I don't see accumulated depreciation in that answer. So the answer is A, right? You bring in the cash, you take the asset off at its original cost. Okay, it originally cost $120, so you have to credit that to get rid of that. And then in this one, I will call a plug. I don't like the plug word. I'm going to call this a plug because it is. There is no theoretical rational way as to how I could tell you to calculate that. It is simply the difference between the cash and the original cost of the asset. Sometimes students will say, well, what happens if you sell it more from the original cost? Well, then I guess you'd credit the accumulated depreciation and you'd get a big handshake from me, because it's highly unusual that you're going to have an asset that you paid X for and then you're going to turn around, a couple years later and sell it for more. Okay, that's like me saying, well, I had my car, I drove my car for 2 years, I paid, $60,000 for the car. Here, why don't you buy it from me for $80,000? No, as soon as you drive the car off you buy the most beautiful car on the showroom floor, you drive it off. As soon as you drive it off, it's worth less than it was when you first got it. So, assets go down in value after you use it for a while. Okay, good. So let's come down and let's take a look at 15 now. We're making good progress, guys. When we look at 15, basically, they're testing us on our impairment rules. So remember there was that chart that we had in the lecture slides where we went through and we said what? First you take the undiscounted cash flows, okay? And you compare those undiscounted cash flows to the carrying value of the equipment, right? If the undiscounted cash flows are more than the carrying value of the equipment, you have no impairment, you're going to stop, right? If the undiscounted cash flows are less than the carrying value, that means you're not going to recover that cost. Now you have impairment. So you go to the next step, which is to what? To calculate that impairment. Okay, and when you calculate that impairment, you're going to then look at the fair value, which is often determined now by discounted cash flows. So it could be the same cash flows that you didn't discount to see if you have impairment. Once you realize you have impairment, right, by comparing that to the book value, seeing that that the cash flows are less than the book value, now you know that you have impairment. You'll take those same cash flows that were undiscounted and discount them to come up with fair value. And the difference between that fair value and the carrying value of the equipment is going to be the calculation of the impairment. Okay, and then you get into some technicalities, which is if the asset is held for use, then you're now going to write it down. You can't write it back up, and you're going to sit there and you're going to use that new recorded impaired value to calculate your depreciation going forward. If the asset is held for disposal, then what? Held for disposal, you are no longer going to depreciate that asset. If the value comes back up, you can restore it, but not past the book value that you had started with. So you can't start taking amounts above and say, wow, now it's really climbing back up. Let me keep adding back to that value. You are capped at that original book value when you started the whole process. Okay, and I think our slide said, okay, and it's part of your operating income. Yes, unless that asset that you're holding for disposal is part of your overall evaluation of impairment of a discontinued segment, then that would actually fall down into the discontinued operations section. I think that's everything anyone wants to know about discontinued operations. Forgive me, once I start running the tape, I can't stop the whole thing from coming out. Okay? All right, so what happens? So in this case, now going back to this easy question, they tell me that the carrying amount is $2,400,000, and they tell me the expected future cash flows is $2,445. Stop. If the cash flows are more than the carrying value, I have no impairment, and I stop right there. Okay. Now you come over to this next question. Okay. And we've got this situation where they bought the equipment for $800,000. The machine had an expected life of 20 years and was expected to have a salvage value of $80,000. On July 1st, 2021, the company reviewed the potential of the machine and determined that the net future cash flows are totaled to be $400,000 and the fair value is $280,000. Okay, so I look at that and I say, well, okay, thank you for telling me that the determined that the net future cash flows are $400,000, and then they give me the fair value, which could be determined by the discounted cash flows. Okay, this is still undiscounted, but I've got to know if that undiscounted cash flow is more or less than the carrying value of the equipment, because if it's more, I'm going to be fine, but if it's less, I'm going to have impairment. Okay, so I got to figure out, well, what is the book value of this $800,000 of equipment they bought? So I sit here and I take this $800,000 and I go ahead and I subtract the salvage value that they gave me, which was $80,000. Okay, that means I have a depreciable base of $720,000, and I'm supposed to divide that by the 20 years. I don't know why I wrote 20 years. Okay, right? Okay, and that gives me then $36,000 per year that I should be taking on this. And then I take the $36,000 per year and I say, well, how many years have I depreciated this? Fingers, guys. All of 2011, all of 2012, all of 2013, all of 2014, all of 2015, all of 2016, all of 2017, all of 2018, all of 2019, all of 2020, and half of 2021, because, and I'm not going to chop off one of my fingers to show you half a finger, 2021, July 1st, that's a half a year, right? Okay, so that means it was what, 10.5 years that they depreciated this thing before they sold it. So if you take 10.5 times the $36,000 per year, you get $378,000. If they bought the asset for what? $800,000. And the accumulated depreciation on this thing now is $378,000. That means that at the time that they are doing their evaluation for the impairment, the asset had a book value of $422,000, right? Meanwhile, they're telling me, hey, they're only going to get $400,000. Again, that's on an undiscounted basis. So they're not going to recover their costs. So that's all step one. So I've done step one. I've determined that there is impairment. Now I got to calculate the impairment. Now this question just was generous enough to me to give me the fair value. The way you would probably do this in practice is then you take the same cash flows that you came up with before, discount them, and presumably the discounted cash flows would be this $288,000. Anyway, I don't have to worry myself about that because they gave me that in this question, the fair value of $488,000. So if I have a piece of equipment that I'm carrying at $422,000, and I've determined now that the fair value is actually what? Only $280,000 on that. That means that I have what? I have $142,000 of impairment, on this. Okay? All right. So, looks kind of hard until you kind of think through what they're telling you there, and then that problem's probably pretty straightforward. Okay? All right, good. Let's go ahead then. And they want to see what I should charge for depreciation here in 2021, and they tell me that the machine's going to become uneconomical after December 31st, 2025, and the machine would have no scrap value, and so they want to know accumulated depreciation as of December 31st. Let's read this whole problem. I'm trying to summarize. Let's read the problem. I think we need to read this one. Number 17. Marsh Corporation purchased machine on July 1st, 2018 for $1,500,000. The machine was estimated to have a useful life of 10 years with an estimated salvage value of $84,000. During 2021, okay, this during 2021 is very important because they're going to come up with a new estimate. And it doesn't matter when in 2021 they came up with this new estimate. We're going to use that new estimate now to help me to calculate the depreciation for 2021. Okay, I don't care if it's December 31st, 2021 they decide this. Anytime during 21, from January to the last day of the year, if we have a better estimate, we'll use that better estimate. Okay, so they tell me that it became apparent that the machine would become uneconomical. During 2021, it became apparent that the machine would become uneconomical after December 31st, 2025, and that the machine would have no scrap value. Accumulated depreciation on the machine at December 31st, 2020 was $354,000. What should be charged for depreciation in 2021? Okay, so first of all, I'm going to take the $1,500,000 on this machine. That's what they bought it for, and I'm going to subtract the accumulated depreciation at the end of 2020 / the start of 2021. December 31st, 2020 is the assets carry over on the balance sheet at that same value for January 1st, 2021. And for this particular asset, it was $354,000 minus $1,500,000. So $1,500,000 minus $354,000 gives me 1,146,000. Okay, good. Now, what happens? They tell me that at the beginning of December 31st, at the beginning or sometime, I don't know if it's beginning and sometime during 2021, they decided that the asset would be uneconomical after December 31st, 2025. So that means that I'm going to be able to use that asset I used, or will be able to use the asset during what? During 21, 22, 23, 24, 25. I've got 5 years that I'm going to be able to use this from the time that I start depreciating it using this new period that I think it'll be useful for, that remaining 5 years. Now, I don't have to worry about salvage value because they told me it'll have no salvage value after that. So I simply take the 1,146,000 and I divide it by those 5 remaining years. And that gives me this 229,200. That becomes my depreciation, and that's my depreciation for 2021, 22, 23, 24, 25. It'll be completely depreciated by the end of that last year that I'm estimating the time left that I will be able to use that. Okay, change in estimate. Notice I'm not going back and restating any other years. No, we don't do that for change in estimate. We just use that new estimate in the year that we change the estimate. And it doesn't matter. I always get that question. Well, when did they do it? Because we would have had to depreciate over the old estimate for half the year. No. Once you have to change that anytime during that year, first day of the year, last day of the year, you use that new estimate to calculate that depreciation for that entire year. Okay? Okay, good. Let's look at this next one now. Number 18, Rogers Company purchased a tooling machine on January 3rd, 2014 for $840,000. And for these questions, guys, notice I'm reading the whole thing, and I suggest that if you have a question that starts giving you all these moving parts in these questions, typically any question, read through the whole question. Sometimes I know when I'm working these with you, I shorthand it. Forgive me for that. If you're not following the fact pattern when you're watching this video, go ahead and pause it, get yourself familiar with the fact pattern, press play again, and I'll work it through with you like we're doing, okay? All right, so Rogers Company purchased a tooling machine on January 3rd, 2014 for $840,000. The machine was being depreciated on a straight line method over estimated useful life of 10 years with no salvage value. At the beginning of 2021, it doesn't matter. In this one, it does matter when they paid this because we are going to add to the value. At the beginning of 2021, the company paid $210,000 to overhaul the machine. As a result of this improvement, this not impairment, it's improvement, the company estimated the useful life of the machine would be extended an additional 5 years. What should be the depreciation expense recorded for the machine in 2021, which is the year that they added this stuff to it, okay? Whatever they paid to overhaul the machine, okay? So what happens? All right, first of all, I've got to figure out, well, what was the book value of the machine at the time that they added this stuff? So what happens? They told me that they bought it for $840,000. They told me there was no salvage value. They told me it had a 10-year life. So I divide that by 10. All right, that's $84,000 per year. Okay, and they depreciated it from what? 2014 all the way to 2021. Okay, so what happens? They depreciate it for all of 14, all of 15, all of 16, all of 17, all of 18, all of 19, all of 20 before they started overhauling the engine or whatever, right? So they had depreciated at that point $84,000 a year for what? For 7 years. So I take that 84,000 times the 7 years. That gives me, I'm going to write it over here for presentation purposes. I'm not drawing it from there. Times 7 years, okay. Gives me what? 588,000. Okay, I'm not trying to erase that. I'm trying to draw a line from the 7 years, John, over to this 588. Okay, right? When you do the calculation, that's what you get. 588, I should say. Okay, and so that means that this thing had a book value when we started 2021 of 252,000. Right? I add to that what they paid to overhaul the engine, 210. So that means now that what? We've got 462. Okay, 462,000. But how many years should we depreciate that over? Well, they tell me in the problem that it's an additional 5 years. So if the thing originally started out with what? 10 years, right? They've depreciated it. We just counted on our fingers to figure out that they depreciated that already what? 7 years, means it had what? 3 years left. But then by overhauling that engine, I just did what? I just added 5 years to the life, the problem told me. So that means that machine should have what? Should have 8 years left on its life. So I take that 462, I divide that by the 8 years that are remaining, and that should give me then this answer of 57,750. Okay? Okay. Not too bad. Okay, we've got this next one, and they want the impairment entry. Okay, so we're back to impairment. Now look, when we have impairment, we take that as a loss on the income statement, don't we? Right? And again, in most cases, it'll be part of my operating income, unless the impairment on the asset is part of the overall evaluation of impairment on an entire segment that's being disposed of, then it should be discontinued operations, right? So if that's the case, we know that when we write it down, when we write that asset off, we know that there's no entry. And since the loss is reported on the income statement, there is no entry to retain earnings. The loss is reported where? On the income statement. And we'll debit loss and we'll credit the accumulated depreciation of that equipment to reflect that loss. Okay, so the answer is C. I barely even need to read that question. Okay, again, on your exam, please read the questions. Okay, but for our purposes here, you can read back over that if you want, but if it's impairment loss, nothing's going to retain earnings. I know that, and I know I have to make an entry. Okay. Okay, good. We're almost there. A couple more questions, guys. Appreciate your patience here, right? We're almost there. And we're going to do this every week. So, you know, start to set some time aside where you're going to say, okay, my lectures are running about 2 hours, so I got to set aside 2 hours to watch my lecture. Going through the practice midterm, yeah, okay, hour and a half, right, or whatever it's going to end up being, right. I'm going to set aside some time for that, and then I'm going to have to set aside some time to look at the homework questions, and I'm going to have to sort of make sure I'm doing my own personal study of this material and whatnot, okay? So yeah, you don't have to come to class. It's a purely online class. You don't come to class, but in a way you are if you're watching these lectures. And then again, you can see the syllabus for my office hours. You can reach out to me, etc. Some of you have already, okay? All right, let's go ahead. Let's knock this thing out. So we've got this Jaeger Corporation purchased a mineral mine for $5,100,000 for removable ore estimated by Geological Survey at 2 million tons. The property is estimated the value, the company has estimated the value of $300,000 after the ore has been extracted. That's sort of like what they can sell it for after they pulled all the ore out. They're not going to get any Pulitzer Prize for the way they phrased that. The company incurred $1,500,000 of development costs preparing the mine for production. During 2020, 60,000 tons were removed and 480,000 tons were sold. What is the amount of depletion that Jaeger should expense for 2020? Okay, good. Now, let's think about this. We have this land and there's some ore underneath the land. That's why we're interested in. So we have to buy that land. Okay, and that gives us the rights to the ore that's underneath it. Now, what are we going to have to do? We're going to have to ready that land. We're going to have to develop that land so we can take the ore out. We'll add that to the cost of that land, right? Okay. Now, they may tell us, this problem didn't have that, but they may tell us that we're going to have to clean this land up after. And I told you the story about the federal agency, the Office of Surface Mining is the federal agency that'll come back behind the miners and make sure they cleaned it up. They're supposed to clean it up. Just a little secret between you and I. Office of Surface Mining has some problems and some hindrances as to how they make the companies clean that up. If they don't clean it up, they fine them. But if the company dissolves, they can't get the fine from a dissolved company, and there are certain legislative limitations. Okay, Electoral College, 7 electoral votes in West Virginia. The politicians don't want to make West Virginia mad because they need those 7 electoral votes. They need those 2 votes in the Senate to get anything passed. If you look at the Senate right now, you've got a Democratic senator, you got a Republican senator. They want to keep everybody happy. And Virginia is a place where coal mining is a major industry. So there's legislative hindrances to the Office of Surface Mining through pure politics to be able to chase a company that polluted the land, pulling some coal out of the land or whatever, pulling coal out of the land and then later messing things up, not cleaning it. They want to chase them. They legally dissolve the corporation. You can't get water from a turnip or blood from a turnip or water from a stone, whatever it is. You can't get that fine out of that dissolved company, but the same people go and form a new corporation over there, and there's legislative hindrances from stopping them to start up a new corporation, so you can't collect the fines from them either. And so it falls on the federal government to clean this stuff up. But assuming we were playing by the rules and we were a good, reputable company, we would have to add the cost of any restoration to my depletable base. And then if I can sell it for something after I've done all that, I want to sell it to a park company or a condo. They're going to put condos where I pulled all this ore out, whatever. Then that would come off the depletable base. Okay. All right. That's just a summary of what we talked about in the lecture. And so what happens? I've got this $5,100,000 that I had to pay for the thing. The property has an estimated value of $300,000, so I can sell it back to somebody, I guess, after I'm done with this. For $300,000, the company incurred what? Actually, let me wait on that $300,000. I'll show you what to do that in a minute. The company incurred $1,500,000 of development costs, so I have to add that. That's that development cost. I got to put some shafts so I can go under there or whatever and get that ore out, right? Okay. Now, since I can sell it for this $300,000, that $300,000 is like a salvage value. It comes off. Okay, so I go ahead and I do the math on that, and I get 6,300,000, and I divide that by the total amount of ore that they can get out of this, which is 2 million tons. For some reason, this sounds like a song to me. 2 million tons of ore. Okay, so we've got this 2 million tons. Sorry, guys, I won't sing to you too much. We've got this 2 million tons of ore. That means that the cost per ton is what? $3.15. Just doing my math up there, right? And squeeze it up there. $3.15. So then they want to know, well, how much should we take as depletion expense? Now, they're bolding this word expense here, okay, because they want you to know that they don't want you to figure out the total amount that would go into inventory. They're calling it expense. The book keeps calling it expense, but on the multiple steps version of the income statement, you would report revenue, whatever you sold that for, right? I'm assuming they would have sold it for more than $3.15 per ton. You sell it for $5 per ton, okay? And if you sold 480,000 tons, $5 times 480 would give you your revenue minus your what? Your sales minus what? Minus your cost of goods sold. And this number that we're about to compute would be rolled into cost of goods sold. So even though they're calling it an expense, it's actually rolled into the line item on the financial statement is called cost of goods sold to give me a gross profit on this stuff. Okay, so the book calls it expense. So that means we have to do what? We've got to take this 480 and we've got to multiply it by what? The amount per ton here that we just calculated of 315. And when I do the math on that, that now gives me what? 1512000. Okay, all right, so I have to pick up that 480 because that's what they sold, not the 600,000. 600 times 315 would be what? Would be a debit to inventory, a credit to my mine, the accumulated depletion on the mine, and then as I sell that, the 480 debit. Again, they're calling it expense. I would say it'd be more correct to debit cost of goods sold and credit the inventory. Okay. All right. This question here, guys, very, very similar. I'm not going to walk through that one. You'll see that it's very similar to the one that we just looked at. Okay. All right, guys. Thank you for your patience. Okay, hopefully I'm going to remember right now. I'm going to do it right now before I forget. I'm going to save as the marked up version. Okay, so I will go ahead and work on that. You don't need to watch me do that. Okay, all right, guys, thanks. I will talk to you soon.